What's up? I'm Dan Fredenberg, and this is for RealEstateisaSCAM.com. And today I've got Bernard on with me. Bernard, do you want to introduce yourself real quick?
Oh, glad to do it. Bernard Reisz, CPA and lead scammer here at RealEstateisaSCAM.com.
Excellent, excellent. Yeah, it's everybody needs a title, right? So this one here, we're going to go through the dirty dozen IRS scams, and we're going to see, like, if it doesn't really relate to real estate at all, then then we'll just mention it in passing. But the main reason why I'm here for being the guy to discuss these different scams is I've got a background in digital security. So I was trusted with hundreds of thousands of credit card numbers, including their billing address and expiry. And my job was to protect transactions and make sure that the outbound marketing, retouching, all that sort of stuff went smoothly so that we'd maintain our 7 figures in sales per year. So, Bernard, do you have are they in order, this dirty dozen of this is the number one and so on? Is there an obvious first one?
Yeah, so they put it into 4 categories. One category, which I tend to talk about more than others, is like the actual tax scams. So we think about stuff that the IRS says, hey, this is fraudulent. People are promoting this. Don't do it. We've got it in the crosshairs. Then there are all sorts of other scams, which are exactly what you describe. Phishing scams, phishing as in PH phishing, right? You get that. I don't know how much, they got phishing, and they've got some new stuff, which are even new to me. Vishing. I'm not sure I pronounced that correctly.
Vishing with a V?
Yeah, is that vishing? Vishing? Yeah, it's got to be vishing. Yes. They call that these are voice-related phishing. Phishing. So it's voice instead of internet phishing. It's vishing.
Well, that's an interesting thing. I don't know if you've seen it or not, but my Figure It Out series, one of the things I was doing as an elaborate organic traffic test is I put out 366 videos on 366 topics in 366 days. And it was basically to say, hey, what's going to happen? And one of the things as a digital security guy that I was concerned about is like, well, great. If, if no matter how it actually pans out, if it has the best case scenario, like huge audience growth, all that sort of thing, or not, it still means that if you wanted to make audio copies of my voice and say anything, you've got 100-hour sample size. It's absolutely bonkers. And so like that's a huge security mistake. And the other thing that I did, which is an even bigger security mistake, is I got a fully digital AI avatar of myself. If you've seen the South Park guys, they did a spoof of Donald Trump. I forgot, it was like Sissy something or whatever. It was a deep fake of Donald Trump and Mark Zuckerberg and whatnot. And mine was done by the same guys. But it's a terrible idea because you literally can feed any script into that face. So if somebody got a hold of it, they could, do a voice call with my parents and say, hey, I'm in trouble, send me some money. And it's my face. It could be my face. It could be my voice. It's all fake,
I just want to thank you for giving me, these are some awesome tips that you're providing.
Right. But the trick is I was wearing my hat the whole damn time. Okay. So they couldn't use it, like it also hit me. It's like, what if they decided that my face is going to become the face of Big Brother? Maybe I'm such a trustworthy person that they decided to make my face say everything that would be my greatest fear, and and people will be subjugated under it. It's a terrifying prospect. But the funnel fixing thing is the best I could do to prevent that. It's like, okay, well, what's funnelfixing.com? It's like, oh, it's about digital funnels.
But how about mom and dad?
Yeah, exactly. How about mom and dad? Well, it's I've got that one covered as a security measure as well. So so that's what I got.
Got it.
Phishing.
Okay.
That sounds what that sounds like that's what that is. But let's so where do you want to start in this dirty dozen?
Let's start with the tax stuff.
Okay.
Let's do the tax stuff. My favorites. So the tax stuff, we'll go through them one by one. And hey, where's this? Whatever, I know that by heart. So the tax ones, and some of them are really real estate related. So a lot for real estate folks here to look out for. Mm-hmm. First one, syndicated conservation easements. Familiar with those?
No, I'm not, but it's got some wheels turning.
Okay, so the syndicated is the same as syndication, right? So syndication, we mostly hear about it with regards to real estate, but there are syndications in every type of industry. It's really folks coming together to do something. So there are syndications in Lloyd's of London Insurance, right? They underwrite things as a syndicate. We say, hey, we're all going to take a slice of the risk. So in a syndicated conservation easement, folks get together in order to get a conservation easement charitable tax deduction. That's a mouthful. Let's describe it. There's a huge incentive to conserve land in the US. So a lot of these things come from a legitimate place in the tax code, legitimate incentive, and then they get used and abused. So Congress said, hey, we want people to conserve land, preserve land for, we don't want mining, we don't want pollution, we want place for people to visit and enjoy and animals to thrive. So say you've got a piece of land that you could mine and it has great value. You could sell it to a company to mine, or you could extract value by mining, or you can develop it and build a 105-story office building and it's going to be worth $1 billion. Mm-hmm. So as an incentive to conserve it, so you can provide an easement. And so an easement is like a right in real estate. And so you can create an easement on that land and donate it to a conservation trust. And essentially what you do, the effect of that is that you restrict forever and ever the use of this land so that it cannot be used for, it can't be mined, and you can't develop it. And now what happens to the value of this real estate? It just plummeted, right? You got it, right? You could have, yesterday, you could have sold it for $500 million. Today, nobody wants to touch it, right? So normally in taxes, you get limitations on what you can deduct. What's the value of a charitable contribution? So sometimes it can only be, the deduction is just in your basis, right? What do you pay for it? We don't care what it's worth, right? And in other cases, the best case, it's like a fair market value. Over here, you go to take the best and highest use. You say, hey, it could be worth that much.
Yeah, if it was, yeah.
Right, and now deduction is a difference. So that can be super powerful incentive. But here's the thing. Generally speaking, right, it's got to be a legitimate fair market value. And in most scenarios in taxes, even when you get a charitable deduction, you're generally coming out economically behind, right? Yeah. So if we think about your typical charitable deduction, I'm not sure how it works up there in Canada. So United States, people sometimes think, let me give charity so I can save on my taxes. That's not smart financially, because all it means is that you get a partner in the tax and in your charity, essentially, right? So say you give $1 to charity. Now that dollar gets taken off your income, right? But how much, but you're still going to be paying, you gave $1 to charity, and you're, let's say, even if you're in the highest tax bracket, you're saving 50 cents in taxes. Right. So you're still out a net 50 cents. Right. So if you give $10 million to charity, and assuming you can claim the whole thing as a deduction, you're still out $5 million. Right. So if you want to grow your own wealth, well, you better just pay the tax and keep the difference. So charitable deductions generally do not make you economically richer, but there's still a good incentive, because if you want to give charity and you need an extra incentive and you say, hey, I don't want Uncle Sam, right? They don't know how to use money well, right? We don't like Big Brother. They're not going to use this money effectively. So I'd rather keep it from them, give it to a charity, and they'll use it well. Charitable incentive. That's the way it works. You're not going to, most scenarios, you're not coming out richer because you got a charitable tax deduction. But how about in this scenario, if you can come tell the IRS, this land here out there in the middle of Oklahoma that nobody has ever looked at, we could have built a $1 billion office complex here right now. And I bought it for $1,000 at an auction where nobody wanted to touch this.
Yeah.
Right. But now I'm saying this could have been a $1 billion property, charitable deduction, $1 billion. Right now you're getting a huge ROI, right? Because you paid $1,000 for the property, but you're claiming a $1 billion tax deduction.
Yeah.
Now you're actually coming out way ahead, right, by making this charitable contribution.
Yeah.
So you can imagine what happens in this space. And now you say, hey, I have nothing to do with $1 billion in tax deductions, right? I don't make $1 billion per year. Right. So let's syndicate the deal. I bought the property for $1,000. We're going to get $1 billion in tax deductions here. Here's what we're going to do. I'm going to sell off slices of this investment for $100,000 a piece. We're going to bring in 1,000 investors, and they're going to pay $100,000 a piece, and they're each going to get a slice of this $1 billion tax deduction, right?
Right.
And these guys, hey, they're putting in $100,000 maybe, but they're getting
maybe for $1 million of deduction, right?
Exactly. Now this is worthwhile. So now let's syndicate the deal. That is a syndicated conservation easement. Now, obviously, this is all illustrated purposes only, right? Even when the IRS, all these cases the IRS are saying are abusive, they're doing appraisals, they're doing stuff. And I'm not saying that every single one out there is a scam. It certainly is not. And neither is the IRS. The IRS is saying, hey, people have been abusing this. We're looking closely. If you do this, it's actually a listed transaction. You got to tell us that you did it. So that is a syndicated conservation easement. You can see where all the abuse can happen. That is at the top of the tax scams.
Yeah, that's really awesome. There's one extra thing I wanted to mention when you were talking about the purpose of charitable deductions. One other thing that people could do with a charitable deduction is they could end up getting they could use the charitable deduction to get into a lower tax bracket, but that's assuming that they're not so high on the highest tax bracket where it's like that's not going to move the needle. If they're more middle class, I guess you could say, then that would be a reason off the top of my head. That is correct, is it?
So not quite, because you're still always going to come out net behind, because the way the tax code works on when you have gradations, when you go into a higher bracket, it doesn't mean that now all your income is taxed at that higher. It's only the amount that kind of goes into that that higher bracket. So generally speaking, by decreasing most deductions are not going to put you ahead, because again, it's not as if you're changing when you go in and out of a bracket. All of a sudden, all your income either went up or went down.
Right.
So that doesn't make a difference.
Right. That makes sense. Okay, cool. So what's next on the list of the dirty dozen IRS? Is it specifically tax scams, or it's just scams?
So it's all tax scams, but some of them are scams that we'll get that are outside of tax year, or like phishing, right? Phishing is rampant. I mean, these guys are getting to be brilliant. It's crazy what I get. Every day, these guys get smarter and smarter. Yeah. But so there are, if we go on to the next one in the tax space, the IRS calls abusive micro-captive arrangements. So what is that? A captive insurance company. You ever heard of those?
A captive, like as in like they're caught?
Yeah. Well, what do you mean? I'll elaborate. So generally speaking, you got business insurance or any type of insurance, you're paying it to some company. I don't know who the big insurance companies in Canada. I don't know who. I don't want to toss out names. I'm not sure. I'm sure some of the names are the same.
You guys would know TD, because that actually stands for Toronto Dominion. So
okay.
So I know that that's all over. It's isn't it called like TD Ameritrade or something like that down there?
Yeah, but that's not an insurance company. It's a
Yeah. Okay.
financial
Well,
services
TD
company.
sells insurance up here. Yeah, and it's also Scotia, and yeah, there are a few.
Okay, so we got here. Let's say you buy an insurance for your business, or you buy a real estate property, right?
Mhm.
And you got property to protect yourself, liability insurance, property insurance to protect the building from, if anything happens, damage. So that's a relationship between two parties that are unrelated. You pay insurance premiums to some company that you don't own, right? And if something happens, you get paid, hopefully, right? You don't deny the claim by some third-party insurance company. Well, some companies are big enough that they're like, hey, we should have our own insurance company. Because think of it this way, without going too far down the rabbit hole.
The house always wins.
But
the math has to work out in their favor, or else they wouldn't even do it, right?
100%. And now the thing is, but that's cool, right?
Yeah.
Because that's value. We talk about risk management, right? We do know that somebody somewhere, whether it be life insurance, knock on wood, right? But somebody's going to get, we know some people are going to die this year. We know some people are going to have vehicle accidents. We know somewhere there's going to be a tornado, there's going to be a hurricane. We know a certain amount of buildings are going to have a fire, right? Now, but nobody knows, and the insurance companies have great statistics to more or less know what that's going to be. They've got it all worked out. But if you're a business owner, you've got one building, right? You don't know, is that going to be my building that's going to burn down? You have no idea, right? So you can roll the dice and say, hey, it's 1 in 1,000 that it's going to be my building. You can take that choice. The thing is, if it happens to be your building, that will be devastating, catastrophic. That more or less can ruin you for life. Right. So if you don't want to take, because you have no way of knowing, we don't know where it's going to strike. We just know it's going to be 1 in 1,000 buildings. Which of the 1,000? Who knows, right? It's totally random. So you can't take a chance on that. You don't want to. The beauty of insurance is like, hey, you don't want to take a roll of the dice on your life, right? It's too catastrophic. So even if it's 1 in 1,000, what we'll do as an insurance company, we will insure 1,000 buildings, right? So we have 1,000 exposures. And so statistically, we know we're only going to have to pay for one, right? So what we got to do, we got to figure out, suppose 1 in 1,000 buildings, I'm simplifying this grossly, but 1 in 1,000 buildings is going to burn down, and the cost of that, fixing that up, is going to be $20 million. Okay, so we just got to collect $20 million of premium from you 1,000 business owners, right? And plus we have to obviously pay our administrative costs and make some profit, right? So say we're going to charge $30 million to these, among these 1,000 building owners. It's a sweet deal, let's say, right? Because what I'm paying a fraction, right, of what it would cost me to protect myself, right? And which I probably couldn't do. And in exchange, I can sleep well at night. No, hey, my risk is gone, right? But so the key thing for an insurance company is that they have access to pooling 1,000 buildings. So now all of a sudden the statistics play a role, right? Because, well, what happens if I own 1,000 buildings myself?
Exactly.
Right. I own 1,000 buildings. Now all of a sudden the statistics play a role. We know, all right, it's 1 in 1,000. Why would I pay $30 million to an insurance company? Right.
But it's going to cost me $20 million to fix my one building that goes down.
Exactly. Let me just set aside $20 million myself, right? Because that's essentially what it's going to cost. So let's cut the insurance company out and put $20 million in a bank account just for whatever happens, right? Yeah. Okay. And if I have 2,000 buildings, I'm oversimplifying, but let's say I'll put in 40 million because the insurance company would charge me 60 million. Right. Okay. Let's take it a step further. Now, rather than just putting the money in a bank account, I'm going to create my own insurance company. That is a captive insurance company. Okay. Right. I'm going to create my own insurance company, and it's going to sell me insurance to insure my 1,000 buildings. Right. Right. So there are a lot of reasons that this makes a a lot of sense. But let's talk
Right.
about the tax side for a moment.
Okay.
The tax side, when you pay insurance company, you get a tax deduction as a business expense, right?
Right.
And insurance company has some sort of income that they'll recognize every year, very complex calculations, right? Now, suppose I want to, so when I pay the insurance company $60 million, we're using crazy numbers now, big numbers, right? I get a $60 million tax deduction, right? But suppose I put $40 million in a bank account to save for the rainy day and cut the insurance company out. Do I get a tax deduction for putting $40 million in a bank account?
Negative.
No, right? It's just an asset. There's no expense.
Right.
But if I can create my own insurance company and I pay, right? I pay the money to my own insurance company.
You deduct it and you keep it. Yeah.
Exactly. I got a tax deduction. So let's say I pay, let's say now I have an insurance company. So it has to run, it's got its own expenses and stuff. So say I'm paying $50 million now because now we have all sorts of insurance operations, right? So rather than paying some other company 60 million, I'm paying my own insurance company 50 million. I'm getting a tax deduction. And so there's a huge net savings here, right? So if you're big enough, it makes a lot of sense. You get all the tax benefits, but economically you come out way ahead because you get the deductions. No insurance company is making money on you and you win. Well, now this sounds, let's throw in another piece. Small insurance companies get to pay zero income tax on their insurance income, right? So insurance companies, right, they're making income. Very complex calculation. They're very attractive, actually, from a tax perspective to be an insurance company. But bottom line, one way or another, they're going to be paying income. So you get an expense for paying the premium, and they're picking up some income because they got those premiums. If you are a small insurance company, you can make a special tax selection in the United States that says, I will not pay any income tax on my insurance income. Now you're understanding how this can be insanely attractive, right? Think about this. I can create my own insurance company, right? I get an expense deduction for paying money to it, right? But on the insurance company side, it does not recognize any income. Right. But that is tax magic, right? Elsewhere, everywhere else in the tax world, there's always a mirror effect, right? Expense to me is income to you. The house, the IRS wins. There's no such thing as having a tax deduction that doesn't have a corresponding tax income, right? There are two sides to a transaction, right? Generally speaking, the rules are always set up that if one party is getting a deduction, the other side is getting taxable income. So the IRS wins. And in almost all scenarios, if for whatever reason, the other side, the party is getting the money, is not recognizing taxable income, then I cannot claim the expense. They go hand in hand, in lockstep. But over here, I can take money out of my left pocket, get a tax deduction, right? And then put it into my right pocket and not recognize any taxable income. Right. Because you have this small insurance company election where you don't recognize any insurance income. Now you're seeing where this gets really, really nice. But what's the problem with this? The problem is a lot of problems potentially.
It's that people want to do that for everything, and that's not going to work. Like everything.
And why won't it work? Because I don't actually want to run an insurance company. Right. And what happens if the building actually burns down? I don't actually want to have to pay that out.
Right.
So here's what we do. I'm being a little satirical, but these things have really happened. You know what? I am going to sell myself insurance, ransomware and kidnap insurance. Right? I'm out here in the middle of Ohio, and I'm a key guy to my business. Without my business, the business is not going to function, right? So I think my business should buy like $1 million of ransomware and kidnap, ransom and kidnap insurance, nobody else is going to sell me that, right? I would never pay anybody else for that either. What, you nuts? I'm going to pay for that? But now it makes sense, right? I'm paying it.
So that I get a deduction and I get to keep the money with no income tax. It's like
exactly. And right, my building insurance, I'm going to keep that with Chubb, right? Let them cover the building, right? But the kidnap and ransom, that's for, hey, no pun intended, captive insurance. That's why it's called captive insurance.
Inc.
It's so just in case I'm ever a captive, they'll pay the ransom.
Yeah, that's
so that is now abusive micro-captive arrangements. Now, each of these things obviously you can fill vaults with the tax law regulations, revenue ruling, case law, and we're pointing out some of the more egregious examples just to illustrate the concept. Obviously, there are legitimate structures out there or various shades of gray. But this is obviously why the IRS is not like this and why they're looking at it, because there are bad apples and these things create opportunities for, people to really abuse the system. But again, there are legitimate folks out there. So don't take this as incrimination of, it just means like, hey, if you get presented with stuff, take a step back and do real due diligence. If it's too good to be true, usually it's either not too good or not too true.
Right. And so this is all for RealEstateisaSCAM.com. And I just want to throw that in since we're going to be cutting this into segments. But I guess another thing I should ask before we go on to the next of the dirty dozen is like, well, do you think, we're going through these different scams. Do you think real estate is a scam as a CPA?
Real estate is a scam. Of course, real estate is a scam. I mean, where else can you have cash flow and not pay taxes? I mean, that's a scam if I ever saw it.
Right. But that part's real. I don't know. It is, sometimes I wonder if the government side of it is a bit of a scam, but because it's definitely in their favor. It's just, just make a little new law and then suddenly it's like, oh, well, a bunch of people's deal structure just falls apart and they're going to have to sell. It's like, oh, that's too bad. It's like, oh, man.
The government, that back like in 08 or 07, somebody, I don't remember who did it, but the same guy, I think, that uncovered Bernie Madoff, he ran the same statistics on the US government. And he said, right, it meets this is like your quintessential Ponzi scheme is the US Treasury. They print money when they want. That's essentially, well, we hope it lasts. We hope it goes. We hope it doesn't collapse. But it definitely, Well,
that's the interesting thing too, is, I was mentioning my body of work with all those different topics. And one of the main ones, and this was being released, I had 100 episodes recorded before lockdown even started. And I was already talking about how the world economy is really run by essential workers. And now that's common knowledge, right? It's like, well, yeah, we saw it because of COVID, right? And I think that is a pretty interesting thing if you're really paying attention to the bigger movements in government and whatnot. But it's well, what can you do? So at the end of the day, though, it's I don't think real estate's a scam, but there's plenty of opportunities to lose your shirt is what I think the truth of the matter is.
I think it's a great concept, because what I always tell people, right, obviously, I probably hope nobody thought I was serious when I said real estate cash flow without taxes, because it absolutely is possible. I hope I hope that's well understood. No. What I love about real estate is that you can actually do that completely legitimately, right? Totally legitimately, totally above board. Hopefully they don't change the rules on us. But it doesn't require a scam. But I do love to say, apply investment concepts. Just like you got to watch out real estate. You can lose your shirt if you don't find the right sponsor and the right deal. do your due diligence on your tax shelters as well.
Right, right. And my series, Figure It Out, that goes along with my Bookorama, Figure It Out, the Attention to Detail Handbook, with that whole side, there's an ethical component, and that's what I was looking for when I was doing the 366 topics. I'm going like, is it actually okay? And what justification is there for basically, the inherited way that all these properties always end up changing hands, except for, when another investor comes in and scoops up a property, it's, can you actually justify saying it's like, okay, you can't live here unless you give money? Well, as a landlord, your job is to make sure the place is nice and then people actually want to live there. So you are definitely providing a service. But as a whole, it's kind of a scary thing from the outset. But the government side of it, the part of using depreciation, asset depreciation as a loss, especially if you're a full timer, so that you actually pay zero tax, or at least there's portions of your income that you pay zero tax on. And income isn't probably the best word for me to be using in that case, but basically the money that you end up taking in. But at the end of the day, governments are supposed to be the caretakers or stewards of the land and the people. And so as a landlord, you're doing the government's job. So absolutely, they should be giving you incentives and advantages. Like I remember reading one of the founding fathers, I think it was Benjamin Franklin, said that taxation is a means of destruction. It's you tax things that you want to go away. And, we've seen that with like the cost of cigarettes in Canada, for example, where, they doubled and tripled and quadrupled the price, and it's all tax. So, but anyway, I don't know if you have anything to add on that, or if you want to go on to the next.
Yeah, there's so much to say. What I think is there's like different ways, different perspectives on tax. There's the level, I think, from the individual taxpayer, that is very clear that the situation that you're in, you maximize the benefits, just like you would any other financial opportunity. It's built into the fabric of the financial and tech, environment. And so long as you're not engaging in fraud, you should use it to the best of your ability, use it in your favor. And it would be wrong to do otherwise, because whatever the stewards of the land wrote the code in a way to kind of pull the levers to an extent. Now, should they change those levers? Possibly, but that's a completely separate discussion of like tax policy. I'm not writing tax policy. I've got all sorts of suggestions. And from a tax policy perspective, there may be things that I would suggest that would be people would love, and some things that people would not love. But I don't write tax policy, so I can I can kind of
soapbox,
pontificate, but it's meaningless. So it's not a good use of anybody's time. But you can say unequivocally, if as long as the tax code works in your favor, work it in your favor.
Right. And that was one thing, like, over here in Canada, we got so much red tape, and, just so much of when I actually went through the tax filing forms and all that, so much of it reeks of, businesses that, they're going like, wow, these, like, they're actually onto the fact that the taxes are inhibitive, but they had enough political sway to turn around to the lawmakers, or at least the people who make the tax laws, and say like, hey, we're paying way too much tax. And they say, oh, no, what exactly is it that you do that's a problem? It's like, oh, well, we do this. It's like, well, what if we, cut you a deal so that you STFU and go away, and then we just keep on doing exactly, with everybody else who doesn't have that kind of political sway. I think that's part of it, but I don't know. I have one of the advantages of even when I was in my early 20s, I had a brokerage for some different retail stores, and so I got to know their profit margins, and that was really revealing to see that like some businesses are trying to make it work on a 10%, whereas most of them, like 60% of the price tag is going to the actual the store, the retailer. So that's the stuff that hits me as kind of interesting as far as like, okay, well, if you're making tax law, you have to take that into account, but who cares about that stuff? Anyway, so your screen froze for me, and that's why I got all stumbly and fidgety. But do you want to go on to the next?
No, I would love to, but I do have to cut it for today.
Okay.
We can pick it up. I thought we'd go through kind of the tax side. Even that we haven't wrapped up. So we can pick it up.
Okay, cool. All right. So I'll hit, so thanks for watching. We're going to have more of these episodes. Stay tuned, subscribe, like, do all that kind of stuff. Subscribing on YouTube, it just means that I show up on your suggestions. It doesn't mean that it's going to like charge you or some garbage like that. It won't bother you, I promise. Anyway, thanks for tuning in. Bernard, if somebody, before you go, can you describe your perfect person for you to give the most benefit to and how they should reach out to you, please?
Perfect person is any person that wants to approach their financials and taxes in an intelligent and discerning manner. If you want to buy something, buy a product that's going to save your financial life, plenty of folks will do that for you. If you want somebody that is actually going to be thoughtful and integrate an array of tax and financial tools, those are the type of folks that I love working with. Thoughtful people.
All right. And should they reach out through LinkedIn or a website or?
Yeah. So LinkedIn, I love LinkedIn. That's how we hooked up. And reshorefinancial.com.
Okay. RESURE.
You got it.
All right, cool. All right. So make sure you like and subscribe, reach out to my man, Bernard, and we'll see you next time. Adios.